When we're looking at costs of capital, we also need to consider not just what does the market think about the required rate of return, but what the value is in the eyes of the market. Investors always have an opinion about the value of a company, and the stockholder is going to believe that the price of stock is an appropriate value. And we're also going to see that this is different than what the balance sheet is going to show for the value of equity. The balance sheet shows the book value of the company. When we're looking at the accounting formula assets equals liabilities plus shareholders' equity, we're really talking about items that are shown on the balance sheet. If the price of a company's stock goes up or goes down, this doesn't change the amount of money that the company has on their books. It doesn't change the number of dollars that they have in the bank. It doesn't change the amount of paid-in capital the company has received, and it doesn't change the amount of retained earnings. So the market value of equity may go up and down with the price, but it's not going to directly affect the book value. When we're talking about the market value, we'd be talking about the market cap or market capitalization that a company has. The market capitalization is simply the price per share times the number of shares. If we have shares of stock that are selling for $28 a share, and there are 1 million shares outstanding, this company would be said to have a market cap of $28 million. We can consider the ratio of the price and the book value as an indicator of how much confidence the market has in this particular company. So if we look at the market cap divided by the total book value, we'd be able to see the price to book ratio. We'd be looking at the price per share divided by the book value per share. And we'd have an idea from this financial ratio of just how much confidence the market has in this company. The next topic we need to talk about is the weighted average cost of capital. Weighted average cost of capital is abbreviated WACC, which is pronounced WACC. So when we're talking about the WACC, we need to keep a couple of things in mind. First, investors care about market value more than book value. And second, that costs of capital are used in making investing decisions. Therefore, if we want to know the overall cost of capital for a company, we're going to use the weighted average of these percentages, and we're going to weight them based on market values. This makes sense for a certain number of reasons. First of all, the rate of return which a company has to get has to keep their investors and their lenders happy. So if a company is going to raise money, for example, to build a new factory or enter into a new market, the use of that money needs to yield a certain result which is going to keep everybody involved happy. It needs to be enough to cover the interest that they're going to have to pay on debt, and it's going to have to return enough to give investors in equity the returns that they want, both in terms of the dividend and the increase in stock price. So when we're looking at the average return that we have to get, we're going to use those market values to get an idea of just what proportion we need to use for each of these parties. And we're going to look at the rate of return which the market is demanding right now, those forward-looking numbers that we talked about earlier, and we're going to simply build the weighted average of them. Now there's one other thing that we need to take into consideration, and that's this. The cost of debt, the interest a company is going to pay, is tax deductible. So when we're making a decision about the weighted average cost of capital, strictly speaking, we really only care about the cost of debt after tax. So we're going to look at our cost of debt, and we're going to look at the after-tax number. So I'm going to look at the amount that's left over after our tax deduction. The cost of debt, KD, times 1 minus T, 1 minus my tax rate, is going to be the after-tax cost of debt. The figure 1 minus T in parentheses like that is called the tax shield. And when we multiply the cost of debt times the tax shield, that after-tax cost of debt represents what the interest burden is going to be after taxes have been deducted to it. This is a number the company is going to make for decision-making purposes, but from the investor's point of view, they still care about what their required rate of return is going to be. I tend to keep cost of debt separate in computations from the tax shield. The author of the book tends to roll them into one number, so when you're doing the homework, it's necessary to be careful that you're answering the right question. You're going to want to look for the problem and see, is he asking for an after-tax cost of debt or a before-tax cost of debt? In my computations, I'll be computing these separately and then showing you how to find the after-tax cost of debt. In most of the homework problems, I believe he's looking for the after-tax cost of debt. So just be aware of that. The weighted average cost of capital, the WACC, is going to be the weighted average of the different types of investment that we have and the appropriate costs of capital. In its simplest form, we'd have the weight of equity, WE, times the cost of equity, KE. And to that, we'll add the weight of debt, WD, times the cost of debt, KD, times the tax shield, So we're taking this as an after-tax figure. If there's preferred stock involved in the company, we simply expand the formula by one more set of factors. So the WACC would become the weight of preferred equity times the cost of preferred equity, plus the weight of common equity times the cost of common equity, plus the weight of debt times the cost of debt times our tax yield. Now I'd like to talk for a moment about the abbreviations that I use. I found that KE and KD are not only fairly standard in the finance world, but they also tend to be less confusing to students. Our author sometimes uses a different set of abbreviations. He might, for example, use KCS for common stock, and he might use KPS for preferred stock, or he might use an R instead of a K. I'm going to stick with the abbreviations as shown, so I'm using a standard terminology in all of my slides, but you need to be aware that some of these other abbreviations are used and watch for them in the textbook. The weight that we're going to be using is that proportion of the type of capital compared to the total capital in the firm. Now, from the basic accounting equation, we know that liabilities plus shareholders' equity equals assets. And when we're looking at the market values, the same thing is true when we're looking at the market value of the total capital in the firm. The total market value of debt plus the total market value of equity is going to be the total market value of the capital in the firm. And when we're figuring out our weighted average, we're going to have to take that into consideration. Consider this example. If we have a company which has equity worth $600 million in the market, and debt worth $300 million in the market, and preferred stock worth $100 million in the market, the total capital the company has out there is $600 million plus $300 million plus $100 million, or $1 billion. Now you can notice that I've abbreviated millions up above, and this allows me to make my computations with fewer zeros. All of those extra zeros, if you're entering them into your calculator, is just one opportunity for a mistake. So I tend to shorten things down, and I just need to make sure I've got them all in some sort of a common denominator. If I'm using millions, I'm going to use millions on all of them. If I'm using thousands, I'm going to use thousands on all of them. In this case, my result, 600 plus 300 plus 100, is 1,000 millions, or $1 billion. If I'm figuring out the weight of each of these types of capital, I'm going to take the market value that it has and divide it by the total capital that I figured out up above. So the weight of equity would be the 600 million divided by the $1 billion. 600 over 1,000 is 0.6. So 60% of the total capital is made up of common equity. The debt, $300 million, makes up 30%. And the preferred equity, $100 million, makes up 10%. Now make a note that, just like in other weighted average problems, the sum of the weights is always going to add up to 1.0. So this is our double check that we're going to use to make sure we've gotten our weights correct.